Hello, everyone. Welcome to Camaplan's Self-Directed 101. We host these weekly every Tuesday in office and online. Um, I'm excited to present to you today. We're going to go over a few useful things and take questions at the end if there are any. And let's get started. Before we get started, actually, we do have a brief disclosure to go through. This is basically just saying that Camaplan is a neutral third-party administrator of IRAs. Everything in this presentation is strictly meant for educational purposes, not to be taken as advice. We are not attorneys, CPAs, or financial advisors. When it comes to a time when you need advice in any one of those fields, we're more than happy to be included in the dialogue you have with those professionals to make sure everything's structured based off their expertise. We don't endorse any investments or sell any investments. We'll never call you about the next best investment opportunities. We always believe that you should do your own due diligence before making any investment choices. So, with that out of the way, let's get started. Some things we'll go over today, just the basics. What is a self directed IRA? What types of accounts can be self directed? What investments you can make, some investments you can't make, a little bit about the process, and some minor tax considerations and resources to talk about at the end for you to take to your tax professional to talk a little bit more in depth and how they may affect you and your plans with your self directed IRA. So, what is a self-directed IRA? You might go to Schwab or Vanguard or Fidelity, and they may tell you you have a self-directed IRA. But what they really mean is you can direct any of your IRA into any of the investments off of this list. With a truly self-directed IRA like the ones offered at Camaplan, there is no list. You find the investment that is right for you, and we'll help you facilitate the transaction into that investment. Self-directed is just an adjective. In reality, these accounts are traditional IRAs, Roth IRAs, etc. Um, all the same rules apply, contributions, distributions. In the eyes of the IRS, it's no different from the accounts you have at these brokers. It's just the investments that you can make. We're able to facilitate where the other custodians may not be able to do so. This is a quote from one of our clients, a longtime client. Investing in what you know, understand, and can control versus using hope as your strategy. A lot of people believe to this day that you can only have your retirement funds linked to Wall Street, in the casino that is Wall Street. But in reality, your options are much more vast than that. And we're going to go over some of those options in just a few slides. As I said, there are plenty of accounts that can be self-directed, and self-directed is just an adjective. Some of those accounts are listed here. We do offer all of these if you're interested as well at Camel You have two different buckets. You have your tax deferred bucket and your tax free bucket. What that means is your tax deferred accounts, you don't pay any taxes on your contributions, but years down the line, when you decide to take those funds out of the account, contributions and earnings, whatever that amount is, you will be taxed on. On the other hand, in the tax free bucket, you're taxed when you put your money in, but years down the line, when you're eligible to take a distribution, those contributions and whatever they grew into, any earnings you've had, if you decide to take them out, are tax free. So the way we like to phrase it is, would you rather pay the taxes on the seed or the harvest? With the tax deferred IRAs, you're paying on the harvest, where the tax free IRAs, you're more so paying on the seed. So in your tax deferred bucket, you have your traditional IRA. We have spousal IRA listed. It's a little bit of it's a little bit confusing because actually spousal IRAs can also be tax free IRAs. Spousal is another adjective like self directed. It just means you have a non working spouse and a working spouse. The working spouse can contribute on behalf of the non working spouse into one of these IRAs. But we just listed that over on the tax deferred side. You have your SEP IRAs, your simple IRAs. These IRAs are linked to employers. And then you have your employer plans, like your defined benefit plan and your defined contribution plans on the tax deferred side. Then when we jump over to the other hand, on the tax free bucket, you have your Roth IRA, you have your health savings account, which is the only account of its type where contributions are tax deferred. And if for qualified medical expense, those distributions are tax free. You also have your educational savings account, ESA, also referred to as Coverdell. And then those employer plans that I mentioned or earlier, like the 401k, can actually have a Roth portion to it as well, depending on the plan and how it was established. Moving forward, here's some differences between a solo 401k and a self-directed IRA. The main differences tend to be the contribution limits, as well as solo 401ks or 401ks in general are the only retirement account that you can actually take a personal loan from if the plan is set up to do so. It's either $50,000 or 50% of the account balance, whichever of those two amounts is less. And then at the bottom, you also see that solo 401ks are not affected by UDFI rules if certain terms apply, whereas IRAs are subject to UDFI tax in the event that they get non-recourse financing, which we'll talk about all of this a little bit towards the end. UDFI, if you're interested now, stands for unrelated debt financed income. But again, we'll go over that when we talk about some tax considerations at the end. This is a little bit of chart to see to show you $100,000 earned through different avenues of investing, whether you're investing your time with your salary or W-2 jobs, your 1099 jobs, if you're investing your personal funds passively, and then your tax deferred and tax free accounts. With your W-2, your salaries, your 1099s, out of that $100,000, in this instance, at a 40% tax bracket, you're paying federal, state, local, Social Security, and Medicare. Your employer is also paying taxes. So, and this depends on where you're located as well, what state and city you may be located in. In this example, that $100,000 that you earned, 40% or $40,000 is going to Uncle Sam to help him keep the lights on, whereas you're only walking away with $60,000. And the example below it, your passive income, your employer's not, you and your employer aren't paying that 15.3% tax. So in this example, it's taxed a little bit less. So that those passive incomes, $100,000 that you made, you're paying $25,000 in taxes or 25%, and that's $75,000 is what you walk away with. Then at the bottom, what we're going to be talking about in this presentation are tax deferred and tax free accounts. Both of those, that $100,000 is $100,000 you get to keep in the account. However, there is an asterisk next to the tax deferred account because when you actually decide to take that money out and use it personally, you're going to be taxed on the amount at distribution. Whereas when you take the money out of the tax free account, when you're of a qualified age to take distributions, that $100,000 is $100,000 cash you're going to walk away with. This is basically the same principle showed in a different way. $50,000 invested at a 10% rate of return at a 30% tax bracket over 40 years. What do you get to walk away with? So you're investing, if you invest $50,000 in your blue or taxable income in this graph, or light green tax deferred income, or your dark green tax free income. So over 40 years, your taxable income only earned $700,000. It's important to note that both the tax deferred and tax free, the light green and dark green bar, they both earned $2.2 million. However, in the light green, you can see that he's only walking away with $1.5 million because he had to pay $700,000 of taxes when the money was taken out of the account. Whereas the Roth IRA or the tax-free accounts, that $2.2 million is cash in their pocket when they take it out of the account. So it's a little reason why I'm a little partial to the Roth IRAs and the tax-free accounts. A lot of people ask, all right, we don't have to have our funds invested into Wall Street. What can we invest into with our retirement plans? We're going to talk about a little bit of these options in depth in the next few slides. So what can you invest in? A lot of things clients that Cayman Plan invest into include real estate, purchasing property from the IRA, private notes and mortgages, private placements, precious metals and other commodities, as well as other options. You're not limited to those options. I've seen people invest into sheep and sell the wool. I've seen people buy bees and sell honey. I've seen people invest into trees and sell fruit. The options are pretty vast, but we're going to talk about these main options real quick in a little bit more depth. So when I say real estate, it can be commercial, it could be residential, single family, multifamily. It could be undeveloped plots of land your IRA can purchase. It can be with a mortgage attached, without a mortgage. It can be foreign properties. It doesn't have to be within the U.S. If you decide to invest into foreign properties, you just want to make sure that you're aware of their real estate laws, their practices, and make sure that they acknowledge the U.S. LLC as an investing entity. but it is possible. We do have clients at Gamma Plan that decide to invest into foreign properties from their IRAs. We'll talk about how this works from a paperwork perspective when we go over the process after we go over these assets real quick. Next asset that's pretty common, a little bit of a passive asset within Gamma Plan, is private lending. Turn your IRA into a mini bank. So these can be secured via mortgage. They can be unsecured. You can buy trust deeds, leases. You can do convertible notes where where the terms of the note uh, transfer into equity into a business at a certain trigger within the terms of the note. You don't have to originate the note. You can actually purchase notes with your IRA on the secondary market. And again, you can secure that via mortgage or other security, or they can be unsecured. Obviously, personally, I'd like my loan secured, but these are the options you can do with private lending through your IRA. Next asset class, probably our most popular asset class at Gamma Plan, is investing into privately traded companies. So before companies go public, most people didn't believe that you can invest with your IRA into these opportunities. However, with a self-directed IRA, you can. So these can be LLCs, joint ventures, settlements, hedge funds, investment clubs, corporations. Your IRA can purchase shares of these privately traded companies before they go public, and you just have to use your self-directed IRA to do so. These investments usually come along with a subscription agreement, a private placement memorandum, and a little bit more we'll talk about in another second. Another common option within Gamma Plan that our clients like to invest into is precious metals. The IRS allows you to invest your IRA into gold, silver, palladium, platinum. There's an option called the Precious Metals Composite that's trademarked by one of the companies that work alongside Gamma Plan. Obviously, do your own due diligence if you want to make that investment. And then certain coins and bullions are allowed within the IRA as well. The IRS does set restrictions on the quality of each of these metals that are purchased within the IRA, how they're minted, and other minor uh, restrictions on what type of metals you can purchase. And you'll see that when we talk about the investments you can't make out of the IRA. So we just talked about what you can invest into with your IRA. Now we're going to talk about what you can invest into with your IRA. So the IRS wants to avoid having hard to value assets within your IRA. These mainly come in the form of collectibles and life insurance. So works of art, somebody can throw paint on a canvas and say it's worth $1 billion or $1 million. And somebody else like myself who doesn't know anything about art will say it's worth $5. You can't purchase rugs or antiques, any of these collectibles, alcoholic beverages. You see how it does say metals or gems are prohibited as well as collectibles. However, like we talked about in the previous slide, they do make that exception for U.S. government minted gold, silver, eagles, coins, and palladium bullions. Each of them have their different requirements that they need to meet, but the precious metals supplier that you work with will most likely be aware of these requirements within the IRA. More transactions that are prohibited by the IRS is self-dealing, personal use, and sweat equity. In the example of real estate, this would come in the form of if your IRA purchased a property, you as the account holder and a number of other disqualified persons to you, which we'll go over in the next slide, are prohibited from receiving a direct benefit from the IRA and its investments, as well as providing a direct benefit to the IRA and its investments. So your IRA owns a property, doesn't mean you can live in it at all. Doesn't mean these disqualified persons can live in it, as well as you can't put in any sweat equity or these disqualified persons can't put in any sweat equity. The IRS wants you to pay somebody a competitive price within the IRA that will be doing work on the property. You can pick the color of the paint, but you can't go in there yourself and paint the walls because that will be providing a benefit to the IRA because the IRA doesn't have to pay those fees for that work to be done because you're doing the work for them, and the IRS does not like that. As I said, there are other disqualified persons to your IRA, including yourself. These people are listed in the blue, so it's mainly people of lineal ascent or descent from you, parents, grandparents, children, grandchildren, and any entity that these people own 50% or more of or have managing control of. However, the people in green aunts, uncles, cousins, siblings, nieces, nephews. They're okay to invest with, invest into, lend to within your IRA. Like I said a few slides ago, we're going to talk about how the process works. A lot of these steps are behind the scenes, us processing paperwork, but at a higher level, what we'll look at is the steps within the 6-step process. So the first step is to open up an account at Camaplan. You want to open up an account at Camaplan similar to the tax status of the funds you plan on funding that account with. So let's say you have a traditional IRA at another custodian that you want to use to self-direct. You want a traditional IRA or another tax-deferred account at Camaplan. If it's Roth, you want a Roth IRA. The next step is to fund the account. In that example where you have another IRA that you plan on working with, you'll want to do a transfer from that existing IRA. These events are not taxable nor are they reportable. If it's coming from an employer plan, you want to do a rollover from that employer plan because it's going from an employer plan into an IRA. You can also contribute to these accounts because, like I said in the very beginning of the presentation, these accounts are traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, HSAs, ESAs. All the same rules apply to these accounts as the accounts at Schwab or Fidelity, contributions, distributions. The only thing that changes is we're able to facilitate transactions into these alternative investments. It takes about 15 minutes to open up an account at Camaplan. To fund the account, because it's not really us that's in charge of that timeline, and it's the other custodian, their processing timelines, and a number of other factors. We tell people to expect on average about 2 weeks. It could be much quicker than that. It could take a little bit longer than that. I've seen people get funded as quickly as the following day after we submit the request, and I've also seen people wait a few weeks depending on that custodian and some other factors as well. After your account's been funded, you'll receive an email notification from Camaplan letting you know the amounts that was received and that your account's been funded. At that point, it's a good time to start working with doing your due diligence on your investment, finding that investment. If it's real estate you're interested in, identify a property. If it's lending, and identify a borrower. If it's private placements you're looking to do, identify a company you want to invest in, and so forth. Next would be to submit the paperwork necessary for us to process that transaction. And this varies depending on the asset class, of course. But one common denominator is our asset purchase directive. That's a Camaplan form that you'll complete. It's a 2-page form. It tells us what you're investing in. Is there a down payment? How much we're sending? Where we're sending it, and how you'd like it sent. Then, if it's real estate, there will be an agreement of sale. If it's a private placement, they'll most likely have a subscription agreement and a private placement memorandum. If it's private lending you're looking at, then there most likely be a promissory note and security paperwork if you want that investment to be secured to something. On all of this paperwork, the lender, the purchaser, the subscriber to these assets, it's not you personally, it's the IRA. It's a separate entity from yourself, similar to a trust. So the IRA is actually making the investment again, not you. The way it looks at Camaplan, it'll be something along the lines of Camaplan FBO, which stands for benefit of your name, IRA or Roth IRA, SEP IRA, simple IRA, HSA, ESA, whatever type of account you have with us. Camaplan FBO, your name, account type. What you'll do is you'll initial next to the signature line on these documents for the IRA. That lets us know that you've read and approved of the agreement. Then we'll go ahead and process that paperwork within 2 business days of receiving everything in good order, and then sign on behalf of the IRA's third-party administrator. Then the funds are sent to your investment provider, title company, or borrower. The asset will show up in your account at Camaplan from your online portal, and then the profits will be returned to the IRA, and then you can just rinse and repeat. I tell people to expect from the date they open the account to the date they make their first investment. On average, it's about 3 weeks, but the biggest chunk of that time, the biggest variable is funding the account. It could be much quicker depending on that variable. Now, why do you need us? So the IRS actually requires that you have a third party keep record of the transactions and report the value of the account to them at the end of every year. And that's what we do. We're a neutral third party. We don't sell anything. We don't tell you what to do. We don't do anything unless you tell us to do it. We keep record of the transactions, report to the IRS at the end of every year, and we're a part of your core team of professionals. At the very beginning of this presentation, I said that we're happy to be a part of any dialogue with your tax professionals, your financial advisors, legal counsel, to make sure that everything's structured based off your team of trusted professionals. That's what we're here for. So do not hesitate. We pick up our phone. We're always happy to be a part of these dialogues to make sure you're comfortable and you have the advice of your professionals alongside with these investments you want to make out of your retirement account. Some frequently asked questions. I'm going to fly through this because a lot of this we already covered. But if anybody has any further questions at the end of the presentation, please feel free to ask. The timeline to open the account and fund a self-directed IRA, we just went over that. 15 minutes to open up an account online, just like opening up an account at your local bank. To fund the account, it varies. It depends on how you're funding it, what custodian you're funding it from, if you're funding it from another custodian and not just making a contribution, how they're sending the funds, their processing timelines, all of that stuff. But on average, it's about 2 weeks to fund the account. Opening the account again is about 15 minutes. How do you fund the account through the IRA, and how long does that take? Just went over the timeline, but to fund the account, you have the option of contributing from your personal funds into the IRA, transferring from another existing IRA into your Camel Plan IRA, or rolling over an employer plan from your existing into your existing IRA at Camel Plan. How do you make the investment into an asset through a self-directed IRA? You'll get the account funded. Then once the account's been funded, you'll submit to us the purchase paperwork, including that asset purchase directive, which is that Camel Plan form we just talked about, and then the supporting paperwork for that investment. So it's either a subscription agreement and a private placement memorandum, a promissory note with or without security paperwork, an agreement of sale, or the property purchase paperwork associated in the state you're doing the purchase. If it's precious metals, you'll have an invoice from your precious metals supplier, and then you submit that to us. We'll process that within two business days of receiving the paperwork in good order, and then facilitate that transaction into that investment. Who signs the paperwork when I invest? Into almost every investment, the Camel Plan signs on behalf of the IRA's third-party administrator, and you'll initial next to the signature line for us for the IRA to let us know that you've read and approved of that agreement. Can I use my IRA for the down payment of a property I want to own personally? The answer to that question is no. That would be considered a prohibited transaction. Whatever percentage the IRA owns of an investment, in this case a property, is the percentage of expenses it has to pay, as well as the percentage of return that needs to go back to the IRA. So let's say you own property 50%. The IRA has to pay 50% of down payment, purchase price, utility bills, renovations, anything associated with that property needs to come 50% out of the IRA, and then 50% of any of the income has to go back into the IRA. So any rental income or the eventual sale of the property, 50% of that has to go back into the IRA. Can my IRA receive a loan to purchase a property to purchase property? The answer is yes. However, it's not through your traditional loan. It has to be through what's called a non-recourse loan. The IRA isn't being made. The loan isn't being made to you personally, so you can't personally guarantee the loan. Loan is going to the IRA, which is a separate entity from yourself. So you would have to find a non-recourse lender to get that financing, excuse me. And that also will trigger UDFI taxes within the IRA, which we'll talk about in another second. And you can bring that up to your tax professional for a more in-depth assessment on how that may affect you if you're deciding to do one of these non-recourse loans within your IRA. Can I manage the property my IRA owns? So manage, it depends on the definition of manage. So you as the account holder, you can identify the tenant you want to work with. You can pick the color of the paint you want to paint the walls. You can pick pick the furniture you want in the building. You just can't go in there and paint the walls yourself, and you can't move the property in yourself or the furniture in yourself. Your IRA has to pay somebody else, a non-disqualified person, to do that work for you. What do I do if or when there's a capital call or additional payments need to be made for an existing asset within the account? What you'll do is once that asset has been purchased, you'll be able to see that asset within your online portal And all you have to do is go in there and submit a payment request, whether it's a capital call, if it's a utility bill, if it's an installment payment on a loan that you're doing. You'll submit that request directly to your online portal and attach an invoice or a capital call notice to that, and we'll process that usually within 1 business day of receiving it. And that's how that would be done from your IRA. Like I said at the beginning, we're going to go over some tax considerations and resources. But I myself and nobody at Camel Plan are tax professionals, and we're not able to give tax advice. So take this information with you with your tax professional to talk more about. So usually IRAs don't pay taxes, but in some instances they do. Those two possibilities are UBTI or UDFI. UBTI stands for Unrelated Business Taxable Income, and UDFI stands for Unrelated Debt Financed Income. Two things that trigger UBTI or can trigger UBTI within the IRA is developing on undeveloped land. So your IRA purchases a plot of land, and then you decide to hire a development company and build on that land. The IRS may look at that and saying you're running a development company, and they're going to hit you with taxes potentially. Talk that over your tax professional. The other thing that I see that has triggered UBTI in the past is flipping properties. What the IRS defines as a flip, they'll never say. Some people say you hold it for a year, you're okay. Some people say if you only limit those flips to this many a year, you're okay. But those people are not the IRS, and the IRS will most likely never say. But the IRS may look at those properties being flipped as inventory in and inventory out. Say you're running a business out of your IRA, which is not within the original intent the IRAs were allowed for. So they may hit you with the UBTI tax depending on some factors they internally determine. The other thing that potentially trigger tax within the IRA, again, these accounts are usually tax sheltered accounts, but another thing that could potentially trigger a tax within the IRA is receiving financing for a property or investment property that you purchase within the IRA. UDFI is unrelated debt financed income. If you get these, if you want to determine whether these taxes are due, talk it over with your tax professional. They'll identify if you need to pay these taxes. They'll identify how much needs to be paid. They'll file Form 990T, send that into Camel Plan. We'll sign on behalf of the IRA, and then send those funds from the IRA to the IRS to pay those taxes. Most people I've talked to that have had to pay these taxes in the past are usually okay with it because based off the interest or the return they're getting, they'd have to pay the taxes on these investments outside of the IRA, and they're still using it to grow the account faster with these self-directed investments than they are with their publicly traded assets. So it really depends on the investment you're making and your tax professional's advice. But these are not very common, but they do happen. So this is just something to be aware of when you're looking at making one of these investments. This here are just a bunch of articles and regulations and forums that we pulled this information from just to communicate with you. We didn't make any of this up. If you have trouble sleeping at night, print these out, keep these by your bedside. I'm sure that'll help. But you see the Form 990T, the prohibited transactions we went over in publication 514, unrelated business income tax publications, and more information that you're free to look at on the IRS website or our website, camelplan.com. That is all the information we have for you today. If you have any questions at any time regarding self-direction and investment you might want to do out of your IRA, you want to talk it over with somebody at Camel Plan, please don't hesitate to contact me. I'm always happy to help. And I appreciate everybody attending. I hope somebody took something from this presentation. Again, don't hesitate to contact us. We're always happy to help, and I hope you all have a great rest of your day.